Imagine a country where filing taxes only takes 5 minutes. Sounds like a dream, right? Well, welcome to Estonia, the country with the world's best tax system. You heard that right. Filing taxes in Estonia is extremely simple. With a flat tax rate that's easy to understand and a computer, anyone in the country can file taxes in as little as 5 minutes. But to be clear, simplicity doesn't always mean it works well. However, in this case, Estonia has been ranked first every year for over a decade on the International Tax Competitiveness Index. So let's look at the index and then learn why Estonia is always number one. The index takes a more quality over quantity approach to ranking. So even if you have the most money or the highest GDP, doesn't mean you score well. They take into account all types of taxes, individual, corporate, and investment taxes, to name a few, and then rank countries on a few major factors. Some of those factors are: what is the tax rate? Typically, countries with high tax rates don't rank well on this list. Overall simplicity. Are there thousands of pages of tax rules, or is it easy to comprehend? Is the tax code competitive and encouraging growth, or is it stifling entrepreneurship? And then they average out those scores to get the final rankings. For reference, Australia ranks 10th on this list with a national GDP of $1.72 trillion dollars every year. Canada is 15th with a GDP of $2.14 trillion dollars. The US is 21st with a GDP of $27.36 trillion dollars, which, for reference, is the largest GDP of any nation currently existing in the world. And the UK is 30th on this list with a GDP of $3.34 trillion dollars. So, how can a small Eastern European country the size of West Virginia, with a population of only 1.3 million people and a GDP of only $40 billion dollars every year, have the best tax system in the world? To start, let's look at Estonia as a whole and get an understanding for their tax system and why it works so well. For those of you who aren't big geography buffs, Estonia is a small country located right next to Russia on the Baltic Sea. It was formerly a part of the Soviet Union and gained independence in 1991. Estonia is a member of the EU and currently uses the euro. The tax system put into place is pretty simple. There are three main elements: one, the personal income tax; two, corporate income tax; three, the value added tax, otherwise known as VAT tax. So let's start with the personal income tax, or sometimes referred to as PIT. Income taxes are no novel concept, but in Estonia, they do things a little differently. Instead of a progressive tax structure like you see in the United States or Great Britain, where the more you make, the higher you get taxed, Estonia is one of only 24 countries in the world that currently use a flat tax system for personal income tax. And in Estonia, it's a pretty simple 20%. That means no matter how much you make every year, Estonia will only take about 20% of it, unlike in a progressive tax system where the more you make, the more you're going to get taxed. So if you make 100K here in Estonia every year, you pay 20K in taxes. Pretty simple. But in America, if you make 100K, you pay around 30,000 every year in taxes. Combine this flat tax rate with a few amount of write-offs, filing taxes for yourself every year is pretty simple. What you see is what you get. To put it in perspective on how simple this whole system is, on average, in most developed countries, it takes over 44 man hours to file taxes, according to impact economists. In Estonia, at most, it can take 2 hours. The next pillar to Estonia's tax system is the corporate income tax. Now, many of you may not know this, but most companies have entire departments working thousands of hours every year to figure out how much they owe in taxes because the systems can be so complicated. But like everything else in Estonia, it's pretty simple and at the same time pretty unique. In Estonia, the corporate tax rate is also 20%, but corporations only pay taxes on distributed profits. That means if a company makes $100 every year in total profit, but they only distribute $10 to their owners, they only pay taxes on those $10. Now, for those of you who don't know, distributing is just simply the act of paying the owners of a given business from the profit of said business. This means, on average, companies pay way less taxes and are encouraged to save and reinvest that money that they're saving into their businesses. Now, I know what some of you may be thinking. This means way less money for the government, since they're only taxing distributed profits. No large country or economic powerhouse could ever get away using a system like this. There's no way they would collect enough tax revenue. And I would say you're right and you're wrong. You would be correct in thinking that countries wouldn't collect enough tax revenue in this scenario compared to their current big budgets. Compared to what companies are currently taxed on, this would be a dramatic decrease. But that's really the reason why this system works so well on the long term outlook. In Estonia's case, the lower tax rate is actually increasing the long term growth. If the company reinvests the $90 in profit that it didn't distribute, then, in theory, and most of the time in practice, they make more money in the future because they chose to reinvest that money. So, in the long term, the money they reinvest compounds at a future rate, meaning much higher taxes for Estonia in the future. I know this may be confusing, so just know basically, less taxes now for Estonia equals more taxes in the future. Now, let's look at the VAT tax, or value added tax. Many developed countries have some form of value added taxes. In Estonia, the value add tax is 20% on almost everything. For those of you who are unfamiliar, these taxes almost work like sales taxes in the United States. So when you buy something, the store either remits or charges you whatever percentage it is for the tax. So if you buy something that costs $10 and the VAT rate is 20%, the taxes paid on that item is $2. Pretty simple. Estonian VAT rates are a little lower than its neighbors like Sweden and Norway, whose VAT taxes are currently around 25%. Now, there are a few exceptions from this 20%. In Estonia, some industries qualify for a 9% VAT tax, like books, hotels, some medical supplies, or sometimes there's even a 0% VAT tax on things like healthcare services, rent, and some financial services. Now, you may be noticing a theme going on. Everything seems to be 20%. Income taxes, corporate taxes, the VAT tax. This is a major part of why the Estonian tax system ranks so high on the international index, because it's so simple. So now that we have a basic understanding of how the Estonian tax system works, we can use that knowledge to figure out why it works so well. While it's impossible to point for any one reason for its success, there are a few major factors that stand out when looking at Estonia's success on the tax rankings. The first of which is simplicity. Like we talked about earlier, 20% is the common number that keeps popping up. With everything having the same rate, minus a few given exceptions, it makes it extremely easy, not only for corporations and individuals to file taxes, but also for the government to audit people. Everything in this system takes less time, which means less money to accountants and less money for government auditors, leading to more efficiency. The other main factor is the corporate income tax system. As I already explained earlier, they only tax distributed profits, which encourages businesses to reinvest their profits. This makes Estonia a much more attractive option compared to other countries when the tax rate is 20 to 30% on everything, whether you distribute that money or not. Because of this corporate income tax system, there are also broad economic impacts as well. The rate of foreign investment has increased significantly in recent years, and business growth has been outstanding compared to its neighbors. With filing taxes in Estonia seeming about as easy as ordering lunch at McDonald's, aren't you wishing your country had a system this simple? I know I am. Thank you so much for watching this video, and if you have any questions or comments, feel free to comment in the comment section down below, and stay tuned for our next video coming out soon.